Hi, my name is Eric. I'll be reading selections from Barron's magazine dated November 3rd of 2025 for people who are blind or print disabled. We'll start with up and down Wall Street. Meta's the poster child for the debate over AI spending. All eyes were on the parade of earnings reports from the technology behemoths this past week. But what grabbed the market's attention were the implications of their massive capital investments in artificial intelligence on their balance sheets and cash flow statements. At the center of this debate was Meta, which plunged 11% on Thursday after reporting a miss on earnings, but more importantly, said it was pushing full speed ahead on AI data centers, projecting $71 billion in spending, up from $69 billion previously. Moreover, the company said that capital expenditures will be notably larger in 2026 than 2025, all of which is absorbing increasing amounts of megatech's cash flow. As Doug Cass of Seabreeze Partners observes, the so-called hyperscalers have morphed from being capital light to capital intensive operations. In the process, they've had to turn to external financing for their ambitious AI buildouts. In fact, Meta brought this year's biggest investment-grade corporate bond deal to market, totaling some $30 billion, the latest in a parade of recent data center borrowing. Bank of America tallies $75 billion of AI-related public debt offerings in the past 2 months. And that doesn't count other financings, including Meta's creative off-balance sheet funding of its Louisiana data center, described by colleague Adam Levine in last week's Tech Trader column. That includes a $38 billion loan tied to Oracle's data centers, on top of $18 billion of public bonds issued by the company, led by world's second richest person, Larry Ellison. Putting numbers to Cass's point, B of A credit strategists Yuri Seliger and Soyun Marie Lee write in a client note that capital spending by 5 of the magnificent 7 megacap tech companies, Amazon, Alphabet, and Microsoft, along with Meta and Oracle, has been growing even faster than their prodigious cash flows. These companies collectively may be reaching a limit to how much AI capex they're willing to fund purely from cash flows, they write. Consensus estimates of AI capex suggest they calculate that it will climb to 94% of operating cash flows, minus dividends and share repurchases in 2025 and 2026, up from 76% in 2024. That's still less than 100% of cash flows, so they don't need to borrow to fund spending. But it's getting close, they add. That leaves no room to return capital to shareholders. The companies could opt to fund AI investments by eliminating share buybacks, which would mean those investments would take the ratio of capex to cash flow back to the low 70% range. Or the companies could take advantage of their stock's elevated price-to-earnings ratios by issuing equity. Much more expedient and more favorable from an equity investor's standpoint is to continue to issue debt. And that's especially so while credit market conditions are so salubrious. According to multiple reports, Meta received over $120 billion of orders for its $30 billion of high-grade AA3 by Moody's, AA- by S&P Global Ratings, bonds on offer, a reflection of massive investor demand for investment-grade corporate bonds. On that point, Kansas City Federal Reserve Bank President Jeffrey Schmid pointed to easy financial market conditions as one reason for dissenting against the central bank's decision to lower its federal funds target a 0.25 percentage point to a range of 3.75 to 4% this past week. Equity markets near record highs, narrow corporate bond spreads, and robust high-yield bond issuance counter the suggestion that monetary policy is restrictive, he said in a statement on Friday explaining his vote. Meanwhile, inflation has exceeded the Fed's 2% target for more than 4 years, he added. Fed Governor Stephen Moran dissented in the opposite direction, preferring a half-point cut as he had at the September meeting. Cass points out that unlike earnings per share, cash flow can't be manipulated by companies. If they spend more on AI than they generate internally, they have to finance the difference. That's no problem currently, especially with the credit markets ready, able, and more than willing to fund megatech borrowers. And the future promise from AI may justify today's spending. But there is a credit cycle, and tech hadn't depended on it until now. The Fed's policy meeting this past week sent shockwaves through the markets, with Chair Jerome Powell's warning that a further interest rate cut at its December gathering was far from assured, contrary to expectations that another quarter percentage point move was all but certain. By contrast, it's unlikely that a similar impact will be felt when the Treasury Department outlines its borrowing plans this coming week. Treasury plans typically don't get nearly the attention of central bank announcements, but its statements could affect bonds and, in turn, other asset prices. That's because the mix of Uncle Sam's securities sales could affect yields, just as Fed operations do. By continuing to lean heavily on short-term Treasury bill sales and not increasing issuance of lengthier notes and bonds, the government could lower the yield on the benchmark 10-year Treasury note by 1/3 of a percentage point over the medium term, according to one estimate. And that's no small matter to the Trump administration. Treasury Secretary Scott Bessent said last Friday that he and President Donald Trump were focused on the 10-year Treasury, which importantly influences other borrowing costs, especially home mortgage rates. The president further said in June that he wanted to refinance $9 trillion in maturing treasuries with short-term debt, which would be replaced after Powell's term as Fed chair ends next May. Then we're going to get somebody into the Fed who's going to be able to lower the rates, he said in an interview with Fox Business. Boosting T-bills' portion of total Treasury financing from about 20% of the total currently, while holding issuance of notes and bonds steady, would have the same effect as cutting the supply of 10-year notes by $1 trillion over the current fiscal year and next, according to a report this past week from B of A Securities rate strategists led by Megan Swibber. They estimate that would reduce the benchmark yield by 31 to 34 basis points, or hundredths of a percentage point over time. In effect, the B of A strategists write, increasing the T-bill share of federal financing amounts to backdoor QE, or quantitative easing. That's when the Fed purchases securities, which colloquially would be called printing money. There's no small irony in this. Last year, Bessent criticized the Treasury, then led by Janet Yellen, for leaning on short-term T-bills in order to hold down longer-term rates ahead of the 2024 election. But he has continued that Biden administration borrowing schedule. Bessent was joined in that criticism last year by Stephen Moran, who co-authored a paper with Nouriel Roubini. Activist Treasury issuance practices, they wrote, were dynamically managing financial conditions and, through them, the economy, usurping core functions of the Federal Reserve. Moran, of course, is now a Fed governor while on leave from the President's Council of Economic Advisors, and this past week dissented for a second time in favor of more aggressive rate cuts by the central bank. Most analysts look for the Treasury to hold its longer maturity issuance steady in the coming quarter. But a surprise cut in the 10 to 30-year range could prompt a yield decline of 10 basis points and as much as 20. According to a note this past week from Wells Fargo strategist Angelo Manalotos. More than the actual size of the reduction, the market will react to the signal sent by such a shift in financing plans, he added. Manalotos sees the Treasury continuing to ramp up its T-bill issues to 24% of the markets by the end of 2027, from 21.5% as of September. J.P. Morgan fixed income strategists, led by Jay Barry, estimate the T-bills share could hit 27% by the end of 2028 if the Treasury solely used bills and didn't boost note and bond auctions. Stepped-up bill issuance by the Treasury would jibe with the Fed's announced end of quantitative tightening, which was anticipated. In addition to no longer letting $5 billion a month of Treasury securities run off at maturity, it'll reinvest principal payments on agency mortgage securities into T-bills. JPM's strategists estimate that the Fed will buy $15 billion a month in T-bills from MBS proceeds, plus another $8 billion a month to offset bank reserve drains from currency demand. Another growing source of demand comes from stablecoins, which are mainly backed by T-bills. The largest is Tether's, which had $157 billion of its stablecoins outstanding at the end of the second quarter, backed by $105.5 billion of T-bills and $16.3 billion of overnight repurchase agreements that were backed by treasuries. That makes Tether one of the largest non-sovereign T-bill holders, with about 2% of total supply. By comparison, the Fed held $195.5 billion of T-bills out of its $4.2 trillion Treasury portfolio as of Wednesday. One recent paper estimates that a 1 percentage point increase in Tether's share of the T-bill market could reduce yields by 14 to 16 basis points. One big question mark is the fate of tariffs imposed by the White House under the International Emergency Economic Powers Act. The Supreme Court is considering the legality of the IEEPA tariffs and will hear oral arguments on Wednesday. If the tariffs are struck down, J.P. Morgan estimates $100 billion of tariff revenue could be eligible for refunds, though it expects actual refund payments would be less and a smaller drain of the Treasury's cash. Beyond influencing interest rates and the economy, Treasury's plans affect federal debt, which just passed $38 trillion, with red ink probably headed to $2 trillion annually over the coming decade, according to the Committee for a Responsible Federal Budget. Every basis point saved in financing costs counts. Interest on the national debt is headed to $1 trillion annually, adds the fiscal watchdog group, which exceeds defense expenditures. But leaning too heavily on T-bills can backfire if short-term rates would have to rise materially. And that was written by Randall Forsyth. Moving to the Streetwise column by Jack Huff, Tesla stock and Musk's $1 trillion robo-ransom. If you've lost the plot to the long-running tech drama Tesla, I have show notes. You'll want to get caught up ahead of next week's twist, and by twist, I don't mean a surprise, but rather a ringing, in this case of a company by its shareholders. On Thursday, they'll probably vote to award CEO Elon Musk an unprecedented $1 trillion incentive package. Or is it a robo-ransom? Here's what to know. Tesla isn't just a 23-year-old car maker whose production and profits peaked 2 years ago. It's also, as it says, a physical AI company, an early contender in 2 artificial intelligence businesses that are as theoretically massive as they are barely existent. The first is operating robotic taxis. The second is deploying humanoid helpers to homes and businesses. These account for almost none of Tesla's current income and most of its stock market value. If it seems like the Tesla show has gone quiet recently, it's because its star Elon Musk has stepped out of the Washington, D.C. spotlight. Last spring, he was head of the Department of Government Efficiency, which he found heaps of taxpayer savings, or barely any, depending on whose accounting you use. But he was neglecting Tesla, investors complained, and his smash-mouth move into anti-left politics had rankled some leaf lovers who buy electric vehicles. It was a code red situation, wrote Wedbush securities analyst Dan Ives, a Tesla Super Bowl on April 20th. Tesla's stock has been crushed amid potentially 15 to 20% permanent demand destruction due to brand damage Musk has created with Doge. Tesla's market value had been cut nearly by half in months to $777 billion, below the ranks of the Magnificent Seven tech world beaters. At the market's number 10 spot, Tesla was sandwiched humiliatingly between an Arkansas mass merchant known for price rollbacks and an Indiana maker of obesity shots, and was a few spots behind a Nebraska investment conglomerate with stakes in reinsurance, wood flooring, and peanut brittle. Then Musk left Doge and got out of politics, mostly. There was a summer spat where Musk tweeted that he got President Donald Trump reelected, and in a now deleted post claimed vaguely and without evidence that the president was mentioned in unreleased Jeffrey Epstein files, quote unquote. Musk was upset by the president's budget bill, which eliminated tax perks for electric vehicle buyers. The episode passed, and so did the bill. Yet, Tesla's market value has plumped back up to $1.5 trillion. It would already be back in the Mag 7 if not for Broadcom recently Kramering into the group. Business conditions for Tesla are better? Maybe worse. It's difficult to say. Third quarter financial results were solid, but that was owed to an EV buying rush ahead of the September tax credit expiration. For October, J.D. Power predicts a 43% EV sales decline. No matter, Tesla bulls and bears alike agree that car making today has little to do with the stock value. BofA Securities puts its contribution at 12%, plus another 17% for full self-driving, or FSD, a subscription service that for now provides, quote, more active guidance and assisted driving under your active supervision. Solar panels and related batteries account for 6% of Tesla's value, BofA reckons. The rest comes from robo-taxis, 45%, and Optimus humanoid robots, 19%. The bull case for Tesla, set forth recently by Rob Wertheimer at Melius Research, who initiated coverage in mid-October at Buy, is that Musk is masterful at moving fast, including into AI data centers, and Tesla's expertise in touching the physical world separates it from other AI giants. It will wreck multi-trillion-dollar industries, starting with cars. Valuation is guesswork, and Wertheimer's guess is $520 a share versus a recent $440. The bear, or neutral, case is simply that it will be a long wait until the new businesses make money. FSD still isn't working as intended, and as long as that's the case, the robotaxi business is likely to remain in part, quote unquote, writes William Stein at Truist Securities, who rates the stock at hold. He assigns Tesla's robotaxi business a valuation of $172 billion, which he notes is only modestly below the market value of Uber, even though Uber, which partners with autonomous driving companies including Waymo, is more active in robotaxi service today. Stein values the stock at $406. It's possible to envision marvelous things for Tesla and still be ho-hum on the stock. BofA recently tweaked its model of cash flows out to 2040 to reflect, among other things, a 40% long-term U.S. market share for Optimus. That's up from a prior 30%, with a penetration rate of 40% for manufacturing and 20% for households. Count me in. I plan to use my unit mostly for high fives and ask only for an AI Mel Blanc voice option that recalls Tweaky from the old Buck Rogers in the 25th Century series. But even with BofA's ambitious market assumptions, it hiked its price target to a level that implies only 7% stock upside and kept its rating at neutral. At Tesla's annual meeting November 6th, shareholders will vote on stock bonuses for Musk that would take his stake from 13% to 25% if he hits ambitious goals. These include taking Tesla's market value over $8.5 trillion in a decade. For comparison, today's market leader, NVIDIA, is worth $5 trillion. There are also operational milestones, from robot deliveries to earning levels. The plan will pass. Betting markets say so, along with key investors. Ives at Wedbush says he has a better chance of starting for the Yankees than the measure failing. If you don't follow New York sports, a Jets or Giants reference there would have left some ambiguity. But a Yankees one means that Musk will get his ransom. Performance plan. Greater voting control is a deal breaker for Tesla's robot future. Musk made clear on the company's third quarter earnings call. If I go ahead and build this enormous robot army, can I just be ousted at some point in the future? He asked. Without Musk and his robots, Tesla's valuation could collapse to that of today's cash-producing businesses, a catastrophic outcome. With Musk in place and chasing his record payday, grumpy valuation math can give way for now to open-ended optimism about Tesla's robo-future. And again, that was written by Jack Huff. Moving on, in Barron's magazine, dated November 3rd of 2025, from the Review and Preview section, Trouble on the Strip. Gambling's everywhere these days, leaving Las Vegas and one of its most famous brands feeling left behind. Shares of Caesars Entertainment tumbled 15.2% this past Wednesday after the casino operator reported disappointing quarterly earnings, driven in part by weak results in Las Vegas. Caesars is on pace for its fifth annual loss in 6 years. While Caesars' regional casino revenue grew, Vegas revenue, about a third of its total, fell 9.8% from a year ago. It was a difficult summer, CEO Tom Reeg said on the earnings call, citing softness in leisure demand for Las Vegas. Caesars Vegas revenue has now fallen for 8 quarters. The gambling industry is changing fast, with online sports betting, prediction markets, and proliferating regional casinos. Companies took a hit in the pandemic. Some diversified MGM Resorts International leaned into BetMGM, its iGaming venture with Entain, which has posted double-digit revenue growth. Wynn Resorts Macau properties saw revenue up nearly 19% from 2023 to 2024, compared with its Vegas unit's 3.7%. Las Vegas Sands doubled down on Macau and Singapore. Caesars knows all of this. It started a digital segment last year that passed $1 billion in revenue and bid for a New York City casino license, but saw its $5.4 billion plan for a Times Square Caesars Palace quashed. For now, the company is still betting on America's playground. We see Vegas coming back strongly, said Reeg, hopefully. That was written by Nate Wolf. What happened last week? In the markets, Argentine President Javier Milei won midterm elections, bailing out the U.S. rescue of the peso. President Trump was in Asia talking trade, while markets awaited the Federal Reserve interest rate decision. On Monday, stocks rallied, with the S&P 500 up 1.23%. The Fed is expected cut rates by a quarter point and ended quantitative tightening. But stocks fell as Chair Jerome Powell raised doubts about a December cut. Trump and China's Xi Jinping agreed to a 1-year trade truce. Big tech, led by Amazon.com and Apple, beat expectations. NVIDIA's market value topped $5 trillion. On the week, the Dow Industrials rose 0.75%, the S&P 500 0.71%, and the Nasdaq Composite 2.2%. In companies, last week, Amazon is laying off 14,000 as it turns to artificial intelligence. NextEra Energy partnered with Google to reopen an Iowa nuclear plant. Brookfield Asset Management agreed to restart 2 South Carolina nukes. Alphabet Meta Platforms and Microsoft reported $80 billion in quarterly AI spending. Solstice Advanced Materials and Quiddy Electronics replaced CarMax and Eastman Chemical in the S&P 500. John Malone is leaving as chairman of Liberty Media and Liberty Global. In deals last week, Novartis is buying Avidity Biosciences for $12 billion. Huntington Bancshares said it would acquire Cadence Bank for $7.4 billion. OpenAI is giving Microsoft a 27% ownership stake valued at $135 billion, and Novo Nordisk bid $9 billion for Metsera, topping Pfizer's $7.3 billion offer. What's happening this week? On Monday, November 3rd, third quarter earnings season has proved to be strong so far, with almost two-thirds of S&P 500 index companies having reported. More than 80% have beaten earnings per share estimates, while nearly 80% have surpassed sales expectations. This week sees another 132 S&P 500 companies reporting, starting with Palantir Technologies and Vertex Pharmaceuticals Monday, Advanced Micro Devices, Amgen, Arista Networks, and Pfizer announce their results Tuesday, followed by AppLovin, McDonald's, Qualcomm, and Robinhood Markets on Wednesday. Airbnb and ConocoPhillips released their earnings Thursday, and Constellation Energy, Duke Energy, and KKR round out the week on Friday. The Institute for Supply Management releases both its manufacturing and services purchasing managers indexes for October. Consensus estimate for the manufacturing PMI, released on Monday, is 494, slightly higher than in September. The services PMI, released on Wednesday, is expected to show a 50.9 reading compared with 50 previously. On Wednesday, November 5th, ADP releases its national employment for October. Economists forecast a 30,000 increase in private sector employment, after a decline of 32,000 in September. And in the numbers, 143%. IMF estimates of U.S. government debt as a percentage of GDP by 2030, from the current 125%. 119. The number of 2025 trading sessions when individual U.S. stocks swung by over $100 billion in value, a record. $11,146. Copper's price per metric ton this past Wednesday, a record, buoyed by supply fears and trade deal hopes. And 3,508, the record number of individual billionaires worldwide in 2024, worth some $13.4 trillion. That's an increase of 10.3%. Moving to the Tech Trader column, written by Adam Levine, big tech earnings just reshaped AI race. Who's winning? Shares of Meta Platforms tumbled 11% on Thursday following the company's latest earnings release, and the slump continued into the end of the week. It wasn't because of sales, which were up a healthy 26% in the third quarter, but rather the mounting expenses from Meta's substantial AI investments. The company's forecast for 2025 capital expenditure investments were revised higher for a third time this year, and CEO Mark Zuckerberg said that the spending would continue next year. It's pretty early, but I think we're seeing the returns in the core business, Zuckerberg said on the Meta's earnings call. That's giving us a lot of confidence that we should be investing a lot more, and we want to make sure that we're not under-investing. Investors who have been patient around Zuckerberg's big AI initiatives have suddenly changed their tune. Total costs were up 32% in the quarter, outpacing revenue growth. Its operating margin was down 2.7 percentage points from last year. Zuckerberg remains a bold CEO who thinks the spending's necessary to keep Meta on top in a rapidly shifting landscape, but investors are growing weary of the hit to income. There's a lag between CapEx and the related depreciation expenses. Wall Street analysts expect Meta's depreciation expense to rise by 48% next year, 43% the year after, and continue its swift rise from there. In the process, depreciation will go from 9% of Meta's revenue this year to 22% in 2030. It's becoming a much more asset-heavy company, which will reshape its financials for years to come. There are two main sources of expense growth. The first is the recent hiring blitz of AI researchers and their reported nine-figure salaries. This falls under third-quarter research and development expenses, up 35% in the year. Share-based compensation for R&D rose 18% in 3 months. The other source of expense growth is depreciation of property, plant, and equipment. Meta's CapEx binge is now projected to reach $70 billion to $72 billion this year. Because CapEx fluctuates a lot year to year, it's given separate accounting to smooth out the lumps. It isn't expensed directly. Instead, companies depreciate these large costs over time, which is what gets counted in the income statement. The largest spend is on the equipment that fills data centers, which gets expensed over 5.5 years in Meta's case. Every $100 billion Meta spends on equipment translates into $18 billion a year in depreciation expense. Meta, which continues to run an impressive advertising business, has become a show-me story. It could be a bumpy ride for shareholders. Apple earnings told a different story this past week. For the most part, the iPhone maker hasn't joined the AI spending race, so its financials and margins have remained largely intact. Apple's cash return program, buyback plus dividend, continues on pace and will soon hit $1 trillion. With its cash holdings over $120 billion, Apple began paying a dividend in 2012 and added a share buyback program the following year. Since then, it's paid out a total of $994 billion, with over half of it coming in the last 5 years. In the process, Apple has reduced the diluted share count by 44%, providing a 78% boost to per-share metrics. Even as its big tech brethren collect AI equipment, Apple is sticking to its rather asset-light ways. Since Tim Cook became chief operating officer in 2005, Apple hasn't operated its own factories, pushing those capital costs onto their contract manufacturers. Apple could try to meet and match the massive capital budgets we see at Meta and the other big spenders, but it isn't the company's style. Time will tell if it's the right decision. Intel continued its cash return program even as Taiwan semiconductor manufacturing passed it by. Intel executives would surely like some of that cash back right about now. While Google parent Alphabet is exceeding Meta in AI CapEx, raising its 2025 guidance to a range of $91 billion to $93 billion, it has more to fall back on, with accelerating cash flows and over $100 billion in the bank. Despite the AI spending spree, Alphabet's free cash flow over the last 12 months is up 32% from the previous year. For Meta, it's down 14%. One of Google's advantages over Meta is its cloud unit, which rents out these AI data centers over the internet. That segment had a strong third quarter with a much improved profit margin. Meta's AI data centers, meanwhile, are just for its own use, meaning all of its AI spending has no immediate revenue to support it. The cloud segment Meta lacks is a strength for Microsoft and Amazon.com. It's the one place all of the AI spending is generating any kind of current return. First quarter revenue at Microsoft's Azure cloud was up 40% on the year. Operating profit margin in the intelligent cloud segment, which contains Azure, was 43%, though that has declined over the past 2 years. Azure provides sales and profit, even as depreciation begins to mount. Amazon Web Services invented the modern cloud, and it's still the largest provider, with $93 billion in sales in the first 9 months of 2025. In the third quarter, AWS sales rose 20% from 2024, but that was outpaced by depreciation-driven expenses, dropping the operating margin by 3.4 percentage points from last year. Still, AWS provides profits that can help fuel the capital spending going forward. For both companies and their stocks, the cloud should provide crucial cushioning in the coming year. Think of it as their AI rainmaker. The next article, by Andrew Barry, Bank of America has a plan to catch up to peers. The forgotten Goliath, quote-unquote, of the big banks is serious about shedding its reputation as an underachiever. The CEO's future may depend on it. Bank of America needs to up its game, and the banking giant is likely to unveil a blueprint for doing just that at its first investor day in nearly 15 years. It's time to consider making a deposit in B of A stock. Bank of America will be holding an all-day investor event in Boston this coming Wednesday, and it will give investors a chance to hear from longtime CEO Brian Moynihan, newly appointed co-presidents Dean Athanasia and Jim DeMare, and other members of the leadership team. The focus probably will be on growth and returns. While B of A stock has risen 21% this year, it lags behind rival JP Morgan Chase, which has gained 29%, a reflection in part of its lower returns, as measured by return on tangible common equity, or ROTCE, R-O-T-C-E. Moynihan looks set to outline how he hopes to close the gap on that key metric. The bank is likely to set a ROTCE target in the 16 to 18% range, up from 14% so far this year, and closer to JP Morgan's 21% return. It's a challenging task, but with one of the better earnings stories among top banks, the least risky loan portfolio, and initiatives to boost returns, it has a good shot at hitting that target. I expect higher growth, return, and earnings, said Mike Mayo, the banking analyst at Wells Fargo Securities, who expects earnings growth of 13% next year to $4.35 a share before it rises as high as $6 a share in coming years. The question is not if, but when, quote unquote. He recently boosted his price target on Bank of America stock to $62 from $60, up 17% from a recent $53. Bank of America has a lot going for it. The company has one of the best franchises in banking, including the number 2 consumer bank behind JP Morgan, a top 5 investment bank, and a leading wealth management arm led by Merrill Lynch. It's also a banking technology leader with the best virtual financial assistant in Erica. The bank has also left a lot on the table. It's useful to compare it with JP Morgan, since the two companies have a similar business mix involving consumer banking, wealth management, commercial banking, investment banking, and trading. Since 2019, B of A's earnings are up by a third based on 2025 projections, while JP Morgan's have nearly doubled. What's the problem? Mayo thinks the bank has been too timid, something that is reflected in the Federal Reserve's stress tests, with Bank of America showing the lowest losses relative to Citigroup, JP Morgan, and Wells Fargo in a downturn, thanks to the high credit quality of the bank's $1.2 trillion loan portfolio. But if Moynihan's mantra has been responsible growth, Mayo thinks it should pivot to more growth, quote-unquote, while maintaining appropriate safeguards. B of A's credit card loan portfolio, for instance, has been little changed over the past decade, while JP Morgan and Capital One Financial have nearly doubled theirs. B of A hasn't chased co-branded credit card deals as much as rivals. Its wealth management business has also lost some of its luster. Merrill Lynch used to be the dominant retail brokerage platform, but the business that was once known as the Thundering Herd for its bullish stance on America isn't making as much noise currently. Morgan Stanley now is the industry champ based on revenue, profits, and margins. Over the past 5 years, Bank of America's wealth management revenue growth averaged 4% a year, against 8% for Morgan Stanley. Revenue growth did pick up to 8% this year. B of A's margins of 24% so far in 2025 were below Morgan Stanley's 29%. Bank of America has also faced investor scrutiny over its poor decision to invest $500 billion in agency mortgage securities at a historic low in rates, mostly in 2021 and 2020. That move has led to paper losses that stood at $71 billion on September 30th and dampened the bank's interest margin as rates rose. Mayo calls that one of the worst mistakes under Moynihan's tenure. But thankfully for the bank, accounting rules don't require the loss to be recognized in its capital position. The good news is that the mortgage securities portfolio is slowly maturing, and that allows the bank to reinvest about $10 billion per quarter at yields that are 2 to 3 percentage points higher, helping to bolster its interest margin. The bank sees higher net interest income and margins in 2026. Some of the bank's efforts have already started to pay off, with its third quarter report showing a 31% gain in earnings to $1.06 a share. Bank of America pays a 2% dividend yield, in line with peers, and supplements that with about $20 billion annually in stock buybacks for a total yield of dividends plus buybacks of 7%. Mayo sees the possibility of even more share repurchases in the next 2 years. The Investor Day is also a chance for Moynihan, 66 years old, to argue for more time as the head of the company. He wants to stay until the end of the decade, emulating J.P. Morgan CEO Jamie Dimon, who's 69, who plans to remain at the helm for a few more years. Dimon deserves to stay given the bank's superior performance and his industry stature. Moynihan's bid is less convincing in light of the bank's mediocre showing. B of A stock has lagged behind shares of Citigroup, Goldman Sachs, J.P. Morgan, Morgan Stanley, and Wells Fargo over the past 5 years. Moynihan's efforts may depend on how well his Investor Day plan is received and executed. He needs to turn the bank's performance from good to great to match peers, and there's the near-term risk that investors sell the stock on the Investor Day news, since Wall Street is already anticipating good news. Still, at just 12.5 times 12-month forward earnings, below J.P. Morgan, Wells Fargo, Goldman Sachs, and Morgan Stanley, there's room for the stock to run if Moynihan gets it right. Mayo calls Bank of America the forgotten Goliath among the country's top banks. Moynihan has the chance to shed that label, deliver for investors, and keep the top job until 2030. Moving on in the Barron's magazine reading of November 3rd, Diversify Out of AI with Boston Scientific Stock by Jacob Sonnenschein. The AI rally has many investors wondering where to turn in anticipation of its end. The medical device maker is one solid option. Investors seeking a stock unrelated to artificial intelligence should take a look at Boston Scientific. The historic rally in everything AI has inevitably led to thoughts about how the whole thing will end. Maybe some companies' earnings will disappoint the market, or maybe something more widespread will occur, like big tech significantly reducing its spending expectations. The tech-heavy NASDAQ composite has seen several days when it was deeply in the red recently, which could foreshadow a true drawdown if any of these or other risks emerge. With all this in mind, we look to medical device makers. These companies are constantly enhancing their products to help improve patients' health. For example, Intuitive Surgical's new versions of its robotic surgery machines have helped the stock rise 23% in the past month. And Abbott Laboratories' newest glucose monitoring device has brought its stock close to new highs. Spending on cardiac procedures in the U.S. is expected to grow at just over 7% annually through 2030 to about $92 billion, driven mostly by an aging population, according to Grandview Research. Boston Scientific is at the heart of it. Of its $20 billion in 2025 sales forecast by analysts, $13 billion is expected to come from its cardiovascular segment, up 23% year over year, according to FactSet. Not all the growth is priced into the stock, now at $100, even after its recent rally. Analysts are forecasting a 13% increase in sales of cardiovascular products next year, to $14.9 billion. The company said at its September Investor Day that it expects low double-digit growth over the long term as it takes market share. Analysts aren't doubting that, especially after the company continued its record of beating quarterly earnings estimates on October 22nd with greater than expected cardio revenue. Part of the cardio growth story is the Watchman product, a small implant that closes the left atrial appendage of patients with atrial fibrillation, or AF. This product is intended to stop blood clots in patients who can't take blood thinners. Watchman lowers the likelihood of clots, reducing the risk of strokes. Watchman sales grew 35% in the third quarter, reaching over 600,000 patients, or 12% of the 5 million total addressable market estimated by the company. The implant is preferred right now versus Abbott Laboratories' competing product, Amplatzer, judging by hospital purchases. Roughly 90% of their AF product purchases are for Watchman implants, according to a physician survey from BTIG analyst Marie Tybalt. That story could continue in the first half of 2026 when Boston Scientific releases results of its Champion AF trial. This clinical trial, reviewed by the Food and Drug Administration, will publish results for Watchman FLX, the latest version of its heart implant. Positive results on its effectiveness and safety would underscore Boston Scientific's ability to continue to grow its presence with heart surgeons and potentially spark stock gains. With large profit margins and hefty free cash flow, an expected $3.4 billion this year and growing, the company has acquired dozens of small companies over the years. An example, it bought Alutia's bioenvelope business for $88 million in September. Alutia sells small materials that protect cardiac patients from postoperative complications such as infection. It's the type of deal that allows Boston Scientific to package multiple products in its offerings to surgeons, providing a competitive advantage. Acquisitions are also instrumental in other areas of Boston Scientific's business, including medical surgical, or med-surg, which analysts expect to grow close to 10% annually over the long term. A subsegment of that business is urology, for which the company bought Axonics for $3.7 billion in 2024. Axonics makes an implantable device that treats bowel and bladder conditions such as overactive bladders. Urology sales could re-accelerate next year, CEO Mike Mahoney said on the third quarter earnings call. Sales were interrupted after Medtronic asked the International Trade Commission to block the sale of the products over alleged patent infringements. Late last year, a jury found that Axonics didn't infringe on Medtronic's patents for competitive products. The companies reached a settlement, and Axonics products are selling without restriction again. Management expects improving growth over the course of 2026, another potential catalyst that could unlock more confidence from the market and stock gains. Overall, Boston Scientific could grow total sales by 11% in 2026 to $23.4 billion, according to FactSet. This would spur mid-teen earnings per share growth annually over the long term, especially as Boston Scientific continues to repurchase shares and onboard acquisitions. The company says it will prioritize deals over buybacks. Given management's tendency to do deals and deliver higher than expected growth, EPS growth could approach 20% annually, says Andrew Choi, a portfolio manager at Parnassus Investments. That would pump the stock higher, partly because it isn't as expensive as it could be. Shares trade at 30 times expected EPS for the coming 12 months, below its peak of 36 times this year. So the stock could trade at a larger earnings multiple and benefit from higher earnings, particularly as the market sees evidence that Boston Scientific can continue to take market share. If they do 11% sales growth, there's a path toward value creation for shareholders, says Choi. This doesn't mean there aren't risks. The Champion AF trial results for Watchman could disappoint, pressuring expectations for Watchman demand. Or Abbott could significantly improve Amplatzert's safety. We doubt those risks will materialize, a key reason being that Boston Scientific can spend a lot of money on research and development to keep its offerings competitive. On the whole, Boston Scientific demonstrates an excellent risk-reward scenario for patients and for those who want to buy the stock. Our next headline, Crypto Treasury stocks face a reckoning. Companies have plowed funds into digital assets. Now plunging stock and token prices are testing their strategy. This is reported by Adam Clark. Buying stocks of companies holding large hordes of crypto has been a hot play this year, but that trade is now at risk of imploding as token prices plunge. The success of Strategy, helmed by Michael Saylor, prompted hundreds of public companies to follow its lead and add cryptocurrency tokens as a treasury quote-unquote asset. Strategy, formerly MicroStrategy, currently holds more than 3% of the world's Bitcoin. Crypto treasury firms initially saw big stock gains after announcing plans to buy crypto. 180 Life Sciences more than quintupled when it began buying Ethereum and rebranded as ETHZilla. 8Co soared 3,000% in a single day on plans to amass WorldCoin. Investments by listed corporations topped $100 billion. According to Galaxy Research, helping drive crypto's total market value to a record of more than $4 trillion. But the surge is waning. More than a quarter of the public companies that adopted a Bitcoin treasury strategy now have a market capitalization below the total value of their digital token holdings, according to K33 Research. That's a potential death blow. On the way up, crypto treasury companies benefit from a virtuous circle. Companies sell shares at a premium to their asset value, using that to acquire more tokens that then rise in value, driving higher share prices, and so on. But when share price premiums disappear, new investors have little reason to buy stock instead of the token itself. Companies may then need to sell assets to cover costs or debt, triggering a downward spiral. In a market where rivals can clone the crypto treasury model overnight and exchange-traded funds offer cheaper, cleaner exposure, the idea that a rich premium can endure was always a fantasy, wrote analysts at investment manager Kerrisdale Capital in a report last month. Kerrisdale disclosed a short position in Bitmine Immersion Technologies, which has more than 3 million Ethereum tokens and is valued at around $14 billion. Short sellers typically aim to profit from a pullback in a stock price. Kerrisdale previously said it was short on Strategy. It didn't respond to a Barron's request asking whether it maintained those positions. Even within the crypto sector, skepticism is growing. Bitmine CEO Tom Lee said the bubble has burst on a Fortune podcast last week. You shouldn't be rewarded for doing something easy, Matthew Hugan, Chief Investment Officer at Bitwise Asset Management, told Barron's at mid-October's European Blockchain Convention, or EBC. Quote, a company that just followed the MicroStrategy playbook of buying Bitcoin and putting it in a box shouldn't trade at a premium to their Bitcoin. It should trade at a discount. The drop in smaller crypto treasury stocks such as Clean Core Solutions, down more than 80% since starting to buy meme coin Dogecoin, have little wider impact. but sell-offs for bigger holders such as Japan's Metaplanet, a top 5 publicly listed Bitcoin holder that's down 65% in 3 months and now trades below its net asset value, could matter more if they're forced to sell their assets. The biggest player is Strategy, with more than 640,000 Bitcoins, almost all of its $82 billion market cap. Barron's wrote skeptically about the stock in December, and since then, Strategy's stock is down 25% and its premium has shrunk. Its enterprise value to Bitcoin ratio is now about 1.4, down from more than 2. A shrinking share price is one thing, but a falling asset value could compound the problems. Bitcoin surged to more than $124,000 last month, but dropped sharply when President Donald Trump threatened new tariffs on imports from China. It now trades just over $110,400. For believers, such crashes are minor setbacks. Standard Chartered's head of digital assets, Jeffrey Kendrick, predicts that the price of the world's largest crypto will reach $500,000 by 2028, pointing to gains in gold. I see Bitcoin and gold as having a similar rationale, Kendrick told Barron's in an interview at EBC. The global asset market is probably well and truly underweight Bitcoin. Strategy's average purchase price is about $74,000 a Bitcoin, giving it a profit cushion. It has issued $14.8 billion in debt and preferred stock, but its holdings cover that. Some worry about its reliance on convertible debt that must be repaid if the stock lags behind the assigned conversion price at the maturity date, though that's years away. Strategy didn't respond to Barron's request for comment. The crypto treasury wave has been a powerful catalyst for the sector in general, but we're about to find out what happens when it recedes. At their simplest, such stocks act as a levered bet on the direction of the particular token they've decided to amass, and when prices go into reverse, leverage inevitably magnifies the pain. And with that, we've come to the end of our reading of this week's Barron's Magazine, dated November 3rd of 2025. This is your reader saying be well, be safe, look after each other, and remember our veterans, especially those we've lost recently. Bye for now.